The next part is labor markets. It's input markets. Labor. We are gonna talking about labor and capital. First, we are talking about labor. Factor demands. The factor markets is the market for labor and capital that determine input prices. Factor demand is the general model for labor and capital. We are interested in marginal benefits and cost of adding an additional unit of labor. So the marginal revenue product is the value to the firm of another unit of labor. So that is the marginal revenue product equals to the marginal revenue times the marginal productive of labor. So the marginal cost of another unit of labor in a competitive labor market is wage, uh, represented by W. If the market is perfectly competitive, the marginal revenue equals to the marginal cost equals to price. The equation above becomes the marginal revenue product equals to wage equals to price times marginal product productive of labor. So firms hire until the wage equals the value of what that workers is producing. Now let's talk about capital. Similarly, marginal revenue productive product of capital is the value to the firm of another unit of capital. So basically MRPK equals to marginal revenue times the marginal productive of capital, where marginal productive of capital in, is the increment in output from one extra unit of capital, holding labor fixed. Firms purchase additional capital until rental rate equals to the marginal revenue per, product of um addition until lease. So the labor supply is deriving labor supply is essentially exploring utility over consumption and leisure. We treat leisure as a good as a normal goods and the consumption as its complement. Wage rate is the opportunity cost of leisure. So when you think about leisure, you need to think about will how if I put those leisure time into work, so I can get those wage. So that is the concept of opportunity cost. The slope of the budget line, the rate at which you can trade off goods for leisure, is wage rate. The wage rate is the price of leisure in terms of goods, and it's also the opportunity cost of leisure. We discuss labor supply using income and substitution effect. Income effect works against substitution effect if leisure is a normal good. So when wage increases, the price of leisure rises because the opportunity cost rises. But higher wage also increases real income. What to know here? The first is derived factor demand inference explain marginal revenue product of labor, and marginal revenue product of capital, which we see here. The marginal revenue product of labor equals to marginal revenue times the marginal revenue equals to wage is wage equals to The marginal productivity of labor times price, and the capital is less. Individual choose between leisure and work, and the ledger's opportunity cost is work's wage. When the wage rises, leisure becomes more expensive. More expensive is holding your utility constant. Um, if you have more leisure, you basically you basically lose more because because your opportunity cost rise, so you should have less leisure. So it's substitution effect. People tend to work more. Yeah. Simultaneously, a higher wage increases real income. Plot a graph that reflects individual trade-off between leisure and consumption. Illustrate the income and substitution effect in the leisure versus consumption graph. The intersection of aggregate labor demand and the labor supply curve is the equilibrium wage and unemployment level. Okay, so what is labor market equilibrium? First, demand for labor is driven by the additional revenue grant generated by hiring an extra unit of labor, which is the value of marginal product. By hiring an extra unit of labor equals to the marginal product. The supply of labor reflects the trade-off between income and labor for workers. So the equilibrium wage and the employment is where aggregate labor demand equals to aggregate labor supply. Supply means now the supplier is people and the demand is firms. Minimum wage effect. What if the government set a minimum wage? A legal imposed wage floor is minimum wage above the equilibrium wage, creates a gap between the quantity of labor supplied and demanded. Employers reduce hiring when faced with a higher mandate wage. Reduce hiring when faced with a higher mandate wage. Um, that's very intuitive because if the price goes rise, you don't want more, while more workers are willing to work at a lower wage, resulting in a surplus of labor, which is unemployment because too much people want to work, but not so many demands. Okay, the next part is monopoly. Sony. A a monopolistic employer faces an upward sloping lower labor supply curve. Employ supply curve, meaning that hiring additional workers requires raising wages for all employers, just like an poisoning effect. Hire, create, sell more, one more additional item, you need to lower down all the prices you create item before. So the marginal cost of labor exceeds the wage paid, leading the monopolistic to hire fewer workers because they don't want to pay a higher wage and pay a lower wage compared to a competitive market. Introducing a moderate minimum wage can counteract monopoly power by setting a wage that align with the competitive market. Just like the, just it's all like the monopoly. Yeah, because here is the concept is similar to poisoning effect. Both firms don't want to hire, and the firms don't want to hire more workers, creates the unemployment. Okay, so the next is what is capital supply? Capital is all the machines, lands, and other physical inputs. Price of capital is the interest rate. The interest rate functions as the cost of borrowing and the reward of saving. First demand for capital depends on the expected return from investing in productive assets relative to the interest rate. Households decide how much to save based on intertemporal preferences, tastes of consumption today versus the consumption in the future. Wage rate is the price of foregoing productive work to take leisure. The interest rate provides the price of foregoing productive savings to take consumption. The interest rates on operate in exactly the same way as changes in the wage rate of labor. What's the takeaway of this? A wage floor set above the market equilibrium reduces the quantity of labor demand and increases the quantity supply, the creating thus creating unemployment. A monopolistic employer faces an upward sloping labor supply curve. So hiring additional workers requires hiring wages for all, making the marginal cost of labor exceed the wage. Monopoly the firms don't want like that. Household allocate consumption across periods by weighing weighting the benefits of consumption now against consuming later, constrained by the interest rate which determines the trade-off. So that's all about input markets, labor and capital. Last last part we are talking about choices over time. So like the today's consumption versus the consumption in the future because of the interest. So the next lesson we're talking about that. Present value. The key insight for thinking about capital markets is a dollar tomorrow is worth less than a dollar today because of like inflation or CPI rises. Money available today is more valuable than the same amount in the future because it can be invested or used immediately. You can use those monies by having them today. Comparing sums across time requires adjusting future amounts to their present day equivalent. The rule of making choices over time is to pick the option with the highest present value. So let's talk about inflation and real interest rate. Inflation erodes purchasing power over time. So nominal returns must be adjusted to reflect real gains by buying power. The real interest rate equals to nominal interest rate minus inflation rate. Because we need to take inflation rate into account. What matters to individual is real interest rate when making decisions. Yeah, because you need to take inflation into account once again. So how is the investment decisions? When making investment decisions, we invest if the present value is greater than zero. Firms evaluate their decisions by weighting upfront costs against expected future payoffs under present values. Consumers think about long-term gains when making decisions about whether or not to incur expenses today. So what's the key takeaways? A dollar today is worth more than a dollar tomorrow because it can be used or invested immediately. Rising prices reduce the purchasing power of money over time. When evaluating future songs, individuals and firms think in terms of what those dollars will actually buy, not just their face value. Okay, so it's all about import markets. We have discussed about labor and capital markets. Let's um very quickly review MP. So we first talk about marginal revenue product of labor and marginal revenue product of capital. Let's cost the labor supply, or just um let's create firms whether to purchase additional capital or purchase additional labor. And the labor supply, just consumption and ladder, we need to take into account. And the opportunity cost is very important. Okay, so minimum wage effects, just like may cause unemployment because wage raises people willing to work, but the demand decreases and the capital supply. Um, just about interest and interest rate matters, and you need to take into account the future. Just over time, present value, inflation, and interest rate. So yeah, to know is a dollar today is worth more than a dollar tomorrow because it can be used or invested immediately. Rising prices reduce the purchasing power of money over time. And when evaluate future songs, individual and firms think in terms of what those dollars will actually buy, not just their face value. Okay, so let's all input markets. The next topic is international trade. I'm gonna to talk about in the next lecture. So thank you for listening today. Bye bye.